Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 15. Mr. X owns a portfolio with the following characteristics. They've given two factors sensitivity for security A and B, and then risk-free security. Expected return also given for A and B, and then risk-free security. It is assumed that security returns are generated by a two-factor model. So if it comes to two-factor model, then it will be arbitrage pricing theory model, wherein the expected return will be found out by risk-free return plus the factor 1 multiplied by the beta 1 for the factor plus the factor 2 multiplied by the beta for the second factor. Now using this approach, we have to find out the requirements. Now the first requirement is if Mr. X has 1 lakh to invest and sells short 50,000 of security B and purchases 1,50,000 of security A, what is the sensitivity of Mr. A's portfolio in to the two factors? So Mr. X has 1 lakh to invest and sells short 50,000. Sells short in the sense even he don't have those shares, still he can sell, which is it signifies that the security is a derivative. So in the first requirement we can see Mr. X position is he has 1 lakh and then he sells short security B, so he will have 50,000 extra in his demat account or the futures or options or whatever account he is maintaining for that derivative transaction. Then 1,50,000, he is buying 1,50,000 of security A using the money in the account, so his position will become 0. That will be the first scenario. So in this scenario they are asking what is the sensitivity of Mr. X portfolio to the two factors. So using these weights we have to find out the sensitivity of the factors. As we can see, security B is minus 50,000 and security A is 1,50,000, totaling up 1 lakh, which the money he has. Now that will be the weight also for the first scenario. So 1,50,000 divided by 1 lakh in security A and negative 50,000 by 1 lakh will be in security B. Now they are asking the sensitivity, which is nothing but the beta to the two factors. So 1.5 multiplied by 0.8 for factor 1 and then security B minus 0.5 multiplied by the 1.5 for factor 1. So beta for factor 1 is 0.45 and beta for factor 2 is 0.3. Now so these are the sensitivities of portfolio with the following factors, which is factor 1 and factor 2. Now the second requirement is if Mr. X borrows 1 lakh at the risk-free rate and invest the amount he borrows along with the original amount of 1 lakh in security A and B in the same proportion as along with the original amount of 1 lakh in security A and B in the same proportion as described in part 1. So the second position will be calculated like this. There are two ways, both will be same only. So if we are considering from the first scenario 0, he is borrowing 1 lakh, then again he is doing the same thing like short selling in security B and then buying A. In the same scenario, the first short selling minus 50,000, uh, again short selling in B, so which will be minus 50 will give us minus 1 lakh. And then in case of A, previously 1 lakh 50,000, and again now 1 lakh 50,000, so will be 3 lakh. This is for A and this is for B. Or we can do in this method also, wherein he has originally 1 lakh and then he is borrowing 1 lakh, so the total amount he has is 2 lakh. The same proportion he has to short sell, so previously he is short selling 50%, again 50% will be 1 lakh, so negative 1 lakh. Then 3 lakh he has in his demat account. Now he is buying A in the same proportion as previously, which is 1.5 times of what he had the money. So 2 lakh he has, so 1.5 times will be 3 lakhs, which will again the position will be 0 after doing this transaction. Now here also same case, short selling minus 1 lakh in case of B, and then A it will be 3 lakh. Now considering these weights, so 3 lakh divided by 1 lakh will be 3 in case of security A, and security B is negative 1 lakh divided by 1 lakh will give us minus 1. These are the weights. And another thing to be noted is, here we are borrowing money, so again it is negative but at 0 rate. So that proportion also has to be considered, which is minus 1 lakh multiplied by 0. So in case of factor 1, the risk-free securities beta is 0, and it is obvious that since it is risk-free, there will not be any sensitivity towards the market return, as the risk itself is 0. Now the same thing, the sensitivity is 0 in case of first one, and even in factor the sensitivity is 0. So considering that the beta is 0.9 in case of factor 1 and 0.6 in case of factor 2. The third requirement is, what is the expected return premium of factor 2? So they are asking expected return premium of factor 2. So we need to find out the factor 2, which is nothing but lambda 2 in this formula, and we already know the expected return of both securities, which is nothing but 15 and 20. So substituting this, we are getting two equations, equation 1 and equation 2. Now using simultaneous equation method or this binomial equation method, we can find reverse calculate and then get this values of lambda, which is nothing but the factors in our case. On solving this, we are getting the factor 1 as 0 and the risk premium factor 2. If we substitute this factor 1 in any one of the equation, we'll get the factor 2 also. That's it. So the risk premium of factor 2 is 8.33. Thank you.